Hi, this is Matthew Cratter from Trader University, and today I want to talk about 5 signs that it's time to buy stocks. If you're worried about this financial crisis, want to learn some bear market trading strategies that actually work, or just see how I'm trading it, be sure to hit that subscribe button. So lots of people have been talking about buying the dip or BTFD and are asking me for a list of signs that the stock market has bottomed, or at least is close to a bottom. As you know, we recently got a death cross in the S&P 500, which is a very bearish sign, and I've been talking about a move lower after this bounce. So what would be some signs, though, that we actually hit bottom and it was time to accumulate for the long term? Well, there's a famous Buffett saying, only when the tide goes out do you discover who's been swimming naked. And what this really means is that a lot of excesses and a lot of bad things and a lot of fraud can happen during good times, and they can really be papered over by a bull market. But a bear market is like the tide going out, and it uncovers all the shipwrecks and all the bodies and everything terrible. And in the past, we've had what people often call a Lehman moment, based on what happened on September 15th in 2008. And this really marked the last violent leg down of the bear market of 2007 to 2009. This is when the Fed made it clear that they weren't going to bail out Lehman Brothers. Lehman Brothers filed for bankruptcy, and then there was this sort of domino effect. Stocks ultimately bottomed early March 2009, but this was still a fairly decent time to buy stocks. So one thing one would be looking for in this market is some big blow up, some Lehman moment. So back in that last crisis, we had Lehman Brothers, we had the uncovering, the revelation of the Madoff investment scandal, late 2008, also very close to the market bottom. In the crisis before that, in the last bear market from 2000 to 2002, which I was trading during, I remember very well these events. We had the Enron scandal, which came public in October 2001. We had WorldCom that ultimately went bankrupt in 2002. And we also had Tyco International, which was committing corporate fraud. So these were sort of Lehman moments from the previous bear market. So there's obviously been a lot of carnage in the last few weeks. Some hedge funds have blown up. But what I would be looking for is something really big, and the tide waters receding, and then something seeing a really big shipwreck there. So sort of a Lehman moment we're still waiting for. The next thing would be some sort of signal from Warren Buffett. He's done this in the past. We do know that Berkshire Hathaway, his company, has been sitting on a lot of cash the last few years, almost up to $130 billion in cash as of November last year. They've also been selling bonds, low interest rate bonds, in Japan and Europe, which means that they're basically, even though they have all this cash, they are raising more money, and they'll use it for acquisitions or for investments. And so word from Mr. Buffett would be very interesting. He has a history of doing this. Back in October 16th of 2008, he did an op-ed in the New York Times, basically saying that his private trading account, private investment account, in which he had only been holding government bonds, U.S. government bonds or treasuries, was now almost full of stocks, and that he had been buying, and he would probably have the entire thing in stocks fairly soon if the market stayed down. So if we look at his timing of this, now obviously Buffett buys based on valuation. He's a value investor, but I think he's also a very smart market timer. He understands macro cycles. He pretends to just be this kindly old grandfather who just snaps up shares of Coke when they're cheap, but he's actually very sophisticated in terms of his understanding of macro variables like interest rates, the economic cycle, etc. He's definitely not someone to be underestimated. And so in the last cycle, in the last bear market, he came out with this editorial, and this was part of a concerted push by the elites to sort of reassure people, and to reassure themselves as well, obviously, that there would be a bottom in this. And so you had Buffett coming out, you had Obama coming out once he got elected, saying that he thought it was a good time to buy stocks, etc. And so let's look at the timing of Buffett's New York Times op-ed, October 16th, 2008. The market peaked the previous year in October 2007. So he let this go on for about a year, for about 12 months from the peak, before he put out this editorial and before he was obviously buying stocks for his private account. So October 2008 puts you right about October 16, 2008, puts you right around here. You can see that there was one more leg lower. He didn't catch the exact bottom. And so there were a few more months of pain ahead. But this would be another sign that it's time to start thinking about buying stocks. Buffett has a history of being a little bit early. There's no problem with being early, especially on long-term investments. But what you don't want is to do something that, I think we're closer to right around here. Now, this is a 2008 chart. Maybe we're seeing a bounce here, but I think they're one or two legs lower. And so, obviously, if you want a dollar cost average in an index fund, if you like the valuation of certain stocks, you like Starbucks or McDonald's here, and you're holding for more than 5 years, this is not to discourage you. This is more kind of a macro timing lecture. But certainly Buffett waited a year, and then maybe he had been buying a little bit earlier. But the key is to buy somewhere around here, even if there's one more leg lower. But buying up here, especially if you allocate all your capital quickly, can be very painful, and you can still have a big drawdown ahead. So that would be the first two signs: Lehman moment, Buffett coming out with an op-ed, Berkshire making some big announcement about a big acquisition, etc. These would be signs that we're much closer to a market bottom. Now, this is from Yardeni Research, and this is I'll put a link in this in description notes below. This is a list of all the S&P 500 bear markets and corrections since 1928. You can see that some of them were extremely deep, especially in the 30s and 1930. Market bottomed, peaked in April of 1930, bottomed in June of 1932. It was down 83%. I don't think we get anything similar to that, but I think it's helpful to look at recent bear markets. The 2000-2002 bear market saw a drawdown of 49%, 49.1% in the S&P 500, lasted 929 days. And then the Great Financial Crisis, 2007, 2009 bear market, we were down 57% on the S&P and 517 days. Now this was last updated on March 23rd, but you can see that we're nowhere near. You'd expect us to be at least a year and a half, 2 years into a bear market. And I'd be looking for a drawdown from the peak of something like, I don't know if we get 50 or 56% this time around, but one way to ballpark it would be to say that we get maybe 40%, 50% down, peak to valley drawdown on the S&P 500, which is really representative of the U.S. stock market and global stock markets as well. And so if we look at what that would involve, let's see, we'll switch this to weekly, and we'll scroll into where we are. You can see this is we're in the middle of the trying to catch the falling knife here. So this market peaked, the SPY, which is the ETF, peaked at 338.34 right up here. And so if we're looking at a 40 to 50% drawdown, a 40% drawdown would take us down to 203 on the SPY, currently trading at around 249 in the pre-market. A drawdown of 50% would take us down to approximately 169. Now that would probably be a pretty extreme scenario. I think fiscal stimulus and the Fed probably prop us up before we get down there. But certainly, if we scroll out here, seeing something like 200 on the SPY, that would only take us back to 2016 levels. A lot of people are watching this sort of saying that all the gains of the stock market during the Trump administration need to be wiped out in order to, and I think we're probably getting close to election levels. I'm not sure that's the best indicator. So yeah, it looks like those levels were closer to like 215 or so. But if you're looking for that peak to valley drawdown of 40 to 50%, you're really talking about close on the SPY below 200, and also maybe a little more time elapsing. It seems like this has been going on forever, but it's really only been going on for about call it a month and a half, not even 2 months. Now, the one wild card here, and the other sign that it could be time to buy stocks, is the notorious money printer. Now, this is for people who aren't familiar with this sort of silly meme. Basically, what banks have been doing what central banks have been doing in a crisis, like the Federal Reserve, is printing money and then using that to buy assets. So printing completely new U.S. dollars and then giving it out, using it to buy treasuries, using it to buy munis, possibly using it to send UBI or checks to all Americans. And so the other sign that maybe we hit a bottom sooner is really an all-out push by the Fed, and maybe something even explicit saying we're going to print. We've already had what's called quantitative easing infinity, where they say they're basically going to provide as much liquidity as possible, and that sort of has stabilized the market. But if I saw something a little more explicit, so looking back 2010, there's some headlines here from the New York Times. Fed stands ready to do more, Bernanke says. This was after the market had already bottomed. We can see today that the Fed is giving big banks the opportunity to lever up their balance sheets a little bit more, and so sort of soak up, become buyers of treasuries and other securities. So this would be the stage that we're at now. Things got so bad in Japan, or really have been so bad over the past few decades, that the Japanese central bank, at least as of the time of this article being published, 2018, their equivalent of the Federal Reserve owned almost 80%, call it 77.5% of the Japanese ETF market. So this is really crazy. This is a central bank creating money out of nowhere, in this case yen, using it to buy stocks. So if we see something similar to that, where the Fed really brings out the big bazookas, the big cannons, and it's done that to a certain extent, but I feel like it hasn't quite done enough, or needs to maybe move up the risk curve, and instead of buying corporate bonds and treasuries, basically all the Fed needs to do is come in and say, we are prepared to buy equities, stock ETFs, something like that, and I think you would see a giant bounce that never looks back. Because the central bank has unlimited firepower, they can print lots of money and use it to buy stocks. This is a crazy world we live in, and in doing so, they're going to drive down the price of the U.S. dollar. They're going to devalue the U.S. dollar, and so the longer this money printer goes, and it's not just the Fed, it's all the world's central banks, but the Fed's really the biggest and most important one, at least at this point, until they totally destroy the country and destroy the currency. As they print money, they can use it to buy things, to prop up asset prices, to prop up housing, stocks, bonds, but in the process, they will devalue the U.S. dollar, as I've talked about in other videos, and this will lead to a continuing increase in scarce assets like gold and Bitcoin, which is one reason I'm so bullish on Bitcoin. So those are the 5 signs that it might be time to buy stocks. I don't think we're there yet. In the meantime, if you're interested, if you've enjoyed this lecture and you want to learn more about how to trade a bear market, you can check out my paid courses online. I've got one on bear market trading strategies, swing trading with options, learn to trade options like a pro. My flagship course, Learn to Trade Stocks Like a Pro, futures, financial statement analysis, etc. And you can get access to all of these courses for just a tuition of just $125 for 30 days access. Now, I know times are hard now, so I want to offer you guys a coupon code. If you just click in the description notes below, it'll take you to this page. You just click Get It Now, which will take you to this checkout page. And if you go down here where it says have a coupon code and you type in YT99, click Update, that's going to take $26 off, take it down to just $99 for 30 days access. You can watch all the courses while you're a paid member, and then you can cancel before the 30 days are up. You won't be charged again. No long-term contracts or anything like that. And if there's a subject you'd like me to cover in future courses and future lectures, as a subscriber, you can request that. And I've actually made whole courses based on students' requests. So if you have a lot of free time at home, are looking to really up your self-education game, this is one way of doing it. So I'd encourage you to check out my paid courses. If you found this video helpful, please hit that subscribe button and the like button. If you have any questions or comments, or just a suggestion for what I should make my next YouTube video about, please leave a comment in the comment section below. Thanks a lot for listening, and I'll see you in the next video.